Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 2. This is section H. This is a remembering and understanding topic. Identify the characteristics of a freestanding and/or embedded derivative financial instrument to be recognized in the financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if this is the first video you're seeing from us, or if you don't know very much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to a lot of great stuff, including the Pro course, where Nate explains in detail, in depth, exactly how you're supposed to pass the CPA exams. It's kind of like a, again, much more in-depth version of the 1-hour webinar. And they also get access to the full versions of these videos. So in today's version of the video, in today's YouTube version, you're only going to get 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other products, make sure you check out becoming a Pro member to get access to the full versions of these videos. Now with all that, let's dive straight into the questions for this video. Alright, here we are at question 1. We're starting off with something pretty straightforward and basic so that we can do the rest of things. Which of the following best describes a derivative financial instrument? So we need to understand what a derivative is. Let's go through the options. Option A, a financial instrument that represents ownership in a company and provides voting rights. Option B, a tangible asset that can be physically delivered to the holder. Option C, a debt security issued by a corporation with fixed interest payments over its life. Or option D, a contractual agreement whose value is based on changes in the price or value of another asset, index, or rate. So again, which one of these best describes a derivative financial instrument? Now, if you already know the definition, that's fantastic. But if you don't know, maybe think about this and give it a guess. Or if not, let's go ahead and take a look at the explanation together right now. All right, here we are. The answer is D, a contractual agreement whose value is based on changes in the price or value of another asset, index, or rate. So again, you might have already known that definition, but let's just go through a brief explanation. A derivative is a contract whose value is tied to the performance of an underlying item, such as a stock price, interest rate, commodity price, currency exchange rate, or market index. So it's tied to something else. The value is tied to the value of something else. The derivative itself does not necessarily involve ownership of the underlying asset. Instead, it provides a way to gain or reduce exposure to changes in the underlying's value or the underlying asset's value. Common examples include options, futures, and swaps, and we'll talk a little bit more about that further in the video. But again, the idea here is that the derivative's value is actually based on the value of the underlying item, and the whole point of it is to gain or reduce exposure to changes in the value of that underlying item. So with that, we learned the basic definition of derivatives. Now let's go to the next question. All right, here we are at question 2. For a financial instrument to be classified as a derivative under US GAAP, it must have all of the following characteristics except. So which one of these is not a characteristic of a derivative? Let's go through the options. Option A, its value changes in response to changes in an underlying asset, index, or rate. Okay, we just barely talked about that, so we probably know that that is a characteristic of a derivative. Option B, it requires little or no initial net investment compared to other contracts with a similar response to market changes. Option C, the terms require or allow a net settlement. Or option D, it must involve the purchase or sale of the underlying asset at contract inception. Okay, so which one of these, again, is not a characteristic of a derivative? We learned basically the definition of a derivative, but what makes a derivative? What does it have to be like? What is the characteristics of a derivative? We're trying to learn that in this question. So if you have a guess or if you already know the answer, great. If not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is D. It must involve the purchase or sale of the underlying asset at contract inception. That is not a characteristic of a derivative. So let's go through this. A derivative has 3 defining characteristics. 1, its value changes based on an underlying variable, such as stock price, interest rate, commodity price, or index. And again, that was kind of like the basic definition that we went over in question 1, but that's just one of the characteristics. 2, it requires little or no initial net investment relative to other similar contracts. And 3, the terms require or allow net settlement. So again, those are the 3 characteristics of derivatives. Derivatives often do not involve an immediate purchase or sale of the underlying asset. Instead, they provide exposure to changes in its value without direct ownership. So again, those are the 3 characteristics of a derivative that you're going to need to know. So pause the video if you need to kind of think over those again. And when you're ready, let's go to the next question. All right, here we are at question 3. Which of the following contracts would generally be considered a derivative financial instrument? So we've been talking about the definition and the characteristics of derivatives, but now we're going to actually start looking at derivatives themselves, like what counts as a derivative, what action or what contract counts as a derivative. Let's go through these options. Option A, interest rate swaps, futures contracts, forward contracts, and options. Option B, corporate bonds, preferred stock, common stock, and treasury stock. Option C, certificates of deposit, savings accounts, checking accounts, and money market funds. or option D, accounts receivable, accounts payable, prepaid expenses, and accrued liabilities. Now, if you were paying attention, we have already talked a little bit about some of this in question 1. So again, which one of these is going to be considered a derivative? If you know, that's great. If not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is A, interest rate swaps, futures contracts, forward contracts, and options. Those are all things that are going to be considered derivatives typically. Let's go through the explanation. Common types of derivatives include swaps, futures, forwards, and options. That's kind of like the easy way to memorize this. Typically, almost anything that's a swap, anything that's a future, anything that's forward, anything that's an option, all of them, if not all of them, are considered derivatives. Each of these instruments has a value linked to an underlying asset, rate, or index, requires little or no initial net investment, and allows or requires net settlement. So they each have those 3 characteristics. Examples include, again, interest rate swaps linked to interest rates, futures and forward contracts that are linked to commodity prices, currencies, or other assets, and options, which are linked to the price of a specified asset or index. These differ from traditional debt, equity, or basic financial assets, which do not meet the 3 defining characteristics of a derivative. So again, now we know the definition, the characteristics, and what is generally considered a derivative. Now let's go to the next question. All right, here we are at question 4. Which of the following derivatives is typically standardized and traded through a clearinghouse? Okay, so if you have no idea what a clearinghouse is, that's okay. I honestly didn't know what it was when I was learning, when I was going through the CPA exams. So let's go ahead and go through these options. Option A, a forward contract. Option B, futures contract. Option C, over-the-counter interest rate swap. And option D, customized currency option between 2 banks. So which one of these is going to go through a clearinghouse? That's the basic question. So pause the video, think about this if you want to, but if you have no idea, again, that is okay. We are using these questions to learn. So let's dive into the explanation right now. All right, here we are. The answer is B, futures contracts. So it turns out futures contracts typically go through clearinghouses. So what does that mean? Let's go through this. Futures contracts are standardized agreements traded on organized exchanges with a clearinghouse. A clearinghouse is an intermediary that stands between the buyer and seller in certain financial trades, guaranteeing both sides fulfill their obligations. It becomes the counterparty to each side, manages daily settlement of gains and losses, and greatly reduces the risk of default. So again, clearinghouse is kind of like the middleman. They're helping the buyer and the seller. They're the counterpart to both the buyer and the seller. They're managing daily settlement of gains and losses. They're reducing the risk for the buyers and the sellers. Clearinghouses are mainly used for standardized exchange-traded contracts like futures. So again, futures almost always go through clearinghouses. In contrast, forward contracts, most swaps, and customized options are negotiated over the counter and generally do not involve a clearinghouse. They usually don't have a middleman. So again, futures contracts typically have that middleman, which is the clearinghouse. The other ones don't. Now let's go to the next question. All right, here we are at question 5. And even though this is question 5, we haven't really had this opportunity yet. So I always like to point this out when it's an option. You want to read the last sentence of a question first if it's an option, because this is a very good strategy for test day. It gives you context for what the question is about, so that as you're reading through the rest of the question, you already have an idea of what you're most likely needing to look for. So let's do that here. In this contract, the 2,500 shares of Delta Corp stock represent which element of a derivative? Let's go to the top. Riverton Co. enters into a call option contract to purchase 2,500 shares of Delta Corp stock at $72 per share anytime in the next 9 months. The contract cost Riverton $4,800 to enter. If exercised, the option is cash settled for its intrinsic value. So again, in this contract, the 2,500 shares represent what element of a derivative? So do they represent the notional amount, the underlying, the initial net investment, or the settlement amount? So if you have an idea, or if you kind of want to think through this, that's great. If you have no idea, again, that's okay. We are using these questions to learn. So pause the video if you want to. If not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is A, the notional amount. So let's go through this. The notional amount is the quantity used to determine cash flows. So here it's the 2,500 shares. The underlying is the market price of Delta's stock, and that's the variable that can change. So again, that is their stock is the thing that's changing and affecting the use of the call option. While $72 is the fixed strike or the exercise price. The $4,800 is the initial net investment, the option premium. That's the money they had to pay to be able to have access to this call option. Because the option is cash settled, if the stock finishes above $72 at exercise, Riverton receives the per share difference between the market price and $72 multiplied by 2,500. If the stock is at or below $72, no cash is received and the option expires because they have no reason to use it. They're not going to use the option when they don't want to pay more money for the shares. Because again, if you think about this, they have a call option to be able to buy the shares at $72 within the next 9 months. But if the shares go above $72, then they're going to buy at $72 because it's cheaper for them. But if the shares go below $72, then that means they don't want to use the option because it would be cheaper to buy them at like $68 or something like that. So again, we learned a little bit more here, but the main thing we needed to learn here was the pieces of the derivative. And in this case, the notional amount is again the 2,500 shares that are being dealt with here. Now, we learned a lot in 5 questions about derivatives, and before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about how to figure out what the different pieces of the derivative are, or what the characteristics of a derivative are, or whatever the case is. You notice these things as you're going through the questions, and you take a moment and write them down in your own words as the pillar topics, the key points of the things that you learned. And as you do this each day, you are building your own personal repository of the most important things you learned from the questions so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for today's video. All right, here we are at the pillar topics. Let's just dive straight in. First off, a derivative is a contract whose value is tied to changes in an underlying asset, index, or rate without requiring ownership of the underlying. So again, it's something whose value is tied to basically the changes in value of something else. Now let's talk about the characteristics. The 3 characteristics of a derivative are value changes with an underlying, so its value changes from the underlying asset or whatever it is, little or no initial net investment, and they do require or allow net settlement. Now let's talk about the third one. Common derivatives include swaps, futures, forwards, and options, each with terms based on an underlying and a notional amount. Again, swaps, futures, forwards, and options, those are the basic derivatives that you should know. Futures contracts are standardized and traded on exchanges through a clearinghouse, which guarantees performance and reduces counterparty risk. So out of those 4 that we just talked about, swaps, futures, forwards, and options, future contracts are the ones that are going to typically be going through clearinghouses, which again, remember, is kind of an intermediary. It's the middleman to make sure that people do what they're supposed to. Now let's do the last pillar topic. Key elements of a derivative include the underlying, which is the price or the rate, the notional amount, which is the quantity, the initial net investment, which is the cost to enter, and the settlement amount, which is the notional amount multiplied by the underlying for CPA exam purposes. And what I mean by that is, technically there's a little bit more to calculating the settlement amount, and you'll most likely learn that in your review course. But a lot of the time, just for basic purposes, the notional multiplied by the underlying amount gives you the settlement amount. It's not always the case. There's technically a more complicated way to calculate that, and maybe we'll talk about that in a future video, but this is kind of a simplified version of that. Now with that, we went over everything that we were going to go over for the YouTube version of this video. Remember, we only did 5 questions, but SuperFast CPA Pro members are going to get access to the full 10-question version of this video, and I'm going to finish that right after I finish this video. So if you liked this and you like our other videos, make sure to check out becoming a SuperFast CPA Pro member, because again, they get access to a lot of great stuff. They get access to the Pro course where we explain how to do the whole process, and they also get access to the full versions of these videos. And if you want to learn about and become a SuperFast CPA Pro member, the easiest way to do that is by first going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and then that will give you a great path to, again, learning about and becoming a SuperFast CPA Pro member. So check out the webinar, check out becoming a pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.